So Moshe, at the end of the year, Mizuho does a survey of investors. We had about 170 accounts, 250 different portfolio managers and traders answered a series of questions for us at the end of the year about what 2024 was going to be like. And what I'd like to do is run you through a couple of the answers to questions they gave and get your take on them for issuers. To set the stage here, right, we had a 2023 that saw about 1.2 trillion of issuance. Our average new issue concessions were around 11 basis points, and our oversubscriptions were about 3.5 times. And a lot of those numbers came down during the course of the last 2 months, right? We had a huge rally in treasuries, a huge rally in spreads as we closed out the year as the Fed pivoted at their December meeting. We came into 2024, and now we're $100 billion into issuance already. Spreads softened a little bit, but over the last few days, they've come right back in as we've gotten to the tail end of this initial issuance coming out of the gates. And so that's the backdrop. We have lower NICs right now and higher oversubscriptions. System seems flush with cash. It almost feels too good to be true at this point in time. So with that in mind, we asked investors heading into the end of the year, what were your biggest risks? What were your biggest concerns? Your three biggest concerns for 2024? The number one concern that they gave us, 60% plus geopolitical concerns. Where do you see geopolitical concerns taking place in 2024? Are they built into the market or are they not built into the market?
Well, let's just start with they're not built in the market. It's very easy for an investor to say that the main thing that troubles me right now is geopolitical concerns, but in the next day, they're buying a 30-year triple B cyclical 10 through the market. So what they talk and what they do is different in this marketplace because there's a litany of geopolitical concerns. Obviously, what we're dealing with right now in the Middle East, but then on top of that, approximately 40% of the global GDP is having a national election this year. Obviously, we're first on that list, and we know how potentially divisive this one can be, and I can guarantee you we're not going to be alone. And when you have a VIX at 12, spreads continue to tighten, high beta and low beta continue to compress, high yield and IG continue to compress, there's a lot of talk, but there's not a lot of conviction behind that concern.
The second biggest concern they brought up was not the level of, but the pace of monetary policy. People seem very committed to the direction of monetary policy, but it's the pace at which they go. Talk about the Fed and what your thoughts are around that pace of monetary policy. When do you think it starts, and how long do you think we drag that out, especially in an election year?
Yeah, I think that's a big caveat, especially in an election year. Look, Victor, I'll give you the house view because I happen to agree with it. So we have, in our view, an economy that has more muscle than I think the market is basically giving it credit for. You have a labor market that continues to be exceptionally tight from a historical perspective. You're seeing turns in housing. You're seeing in Manhattan, for example, you had the first monthly increase in rent in 7 months. So in our view, that is something that's going to carry through, and we are more in a low landing scenario than a soft landing scenario. And when you look at that in that construct, it's hard to rationalize the level of price cuts that are currently being baked into the market. Now, I will say the one asset class that is not fitting that narrative is oil. Oil has failed to gain any sort of traction ever since this market did the pivot turn on November 1st. So you have oil, you have financial conditions easing materially, you have what's going on in the Middle East, obviously, and yet WTI is having a hard time staying above 70. That is the one issue with the narrative I'm speaking about, which is one of the reasons I'm laser focused on what's happening in the commodity market.
So you think it's going to be a longer, or less and longer, it sounds like to me.
I think it's a less and longer. I mean, even if you listen to the Fed saying that they're going to get core PCD down to 2.6 in a couple of years, and we have the 10-year at 4%.
Well,
right? I mean, at that level of inflation, even if the Fed's running real rates at 1%, you're at 360 on Fed funds, which puts you north of 4 on 10s.
Well, that brings us to, brings us to another question on the survey. We asked accounts, where were rates going to be? Where are they going to be by June 30th, 2024, and where are they by year end? And here's a surprising statistic. 97% of accounts believe that rates are going to be sub 4%. And of those, the vast majority, probably 85% of all accounts asked, felt they were going to be below 3.75%. And a large portion of those thought it was going to be below 3.5%. Agree? It sounds like you don't agree with that.
Well, I'll tell you two things. The way the market is trading right now, it's saying that those people are going to be right. I mean, this is a day where we had a hotter than expected inflation report, a hotter than expected claims report, and yet rates are lower. And I've always been schooled by the technical fact that how an asset class behaves to perceivably bad news is a good tell on where it's going to go. And Treasuries traded very well today, given that. But again, very focused on what's going to happen with the commodity market. I think it's important to note, Victor, because you brought up liquidity. And that's a very important thing because liquidity greases the economic engine. And I would argue, based off of what we're seeing right now, we have one of the most powerful liquidity environments that, frankly, I've seen since COVID. And you're seeing that in terms of the record amount of demand for sovereign auctions in Spain, for sovereign auctions in Belgium. You're seeing that in the oversubscription levels that we're having on the transactions.
Up over 4 times right now.
That we recently brought to market. So when you have liquidity, that amount of liquidity out there, and that's not even factoring in the $6 trillion that are stuck in money market funds, it's hard to see the type of slowdown that would warrant that type of move in both inflation and the economy. And on top of that, you have a fiscal dynamic, which is more supportive of higher than lower rates. A stat I heard the other day was that global net supply from sovereigns in 2024 is estimated to be $2 trillion, right? And that's $2 trillion. And we have to remember that central banks are reducing their purchases of other sovereign debt. That's a byproduct of deglobalization. So that means that all these sovereigns are going to be that much more reliant on the home country bid, which technically, again, makes me hard for me to embrace that 3-handle rate narrative.